You're listening to the Real Talk Real Estate Show with your host, Clayton Hepler.
Between co-founding Jake and Gino, a multifamily real estate education company, one of the leading companies in the United States, and having over 4 different podcasts on his Jake and Gino platform, Gino Barbaro is making a real impact on the multifamily real estate industry. He is a self-described educator first and investor second. And he's just getting started. So please help me in welcoming Gino Barbaro to the Real Talk Real Estate Investing Podcast.
Awesome. Gino, thank you so much for joining us today, man. I really appreciate it.
Clayton, the pleasure's all mine. How you doing?
I am doing well. It's probably not as nice up here in Pittsburgh as it is down there in Tennessee.
74 and sunny in St. Augustine. Right off the beach.
Oh, Sam.
Oof. A lot of you.
That's good stuff. That's good stuff. So I'd like to take a little bit of a kind of a turn off the bat. I know you from the Jake and Gino community, but you're kind of a very multifaceted investor. But I want to kind of go right from the beginning, get down to the meat and potatoes, and then we can learn a little bit more about your journey. But you know, there's a million podcasts out there about kind of your journey. Why do investors in multifamily real estate fail?
Just like everything else in life, why do people fail? I can bring you to water, Clayton. I can show you the water. The water is sparkling. It's fresh. It's delicious, but I can't make you drink it, Clayton. You need to drink it on your own. And I think everyone at some point in their life knows the water is good. They just have to take that step to drink it. I was just listening to Jim Rome in my car about 2 hours ago. We all have to change the philosophy of our lives, right? If we are not achieving what we want to, we cannot blame society. We cannot blame the government. We cannot blame our jobs. Our employers aren't paying enough. My wife is driving me nuts. We need to take responsibility and change our philosophy. And as Jim said, it's easy to do something, and it's also easy not to do something. So you have to choose what you need to do in life and follow those choices. And my, accumulation of being on this planet for 49 years, having 6 kids, having a wonderful life, having a fulfilling life now, a lot of bumps and bruises on the way. And when I read T. Harv Eker back in 2008, I got punched in the gut, and it really bothered me because I'm like, this, I don't want to curse, but I said, this asshole, how does he know my life? Why is he judging me? And I'm saying to myself, wow, this guy is so totally right. It's me. The fruits are in the roots. My roots weren't strong. I had very weak roots. I didn't know what I was doing. I didn't have the education. I didn't have the knowledge. I didn't have the network. I didn't have all those skills. It wasn't T. Harv's fault. He was just showing me what I didn't have. And with taking responsibility, because ultimately anyone who has responsibility in life, the definition of an entrepreneur by Rick Sapio, anyone who takes responsibility. That can be a housewife who takes responsibility of their family. That could be somebody who has a 9-to-5 job and shows up every day. Mm-hmm. As long as you start taking responsibility for your life, and as long as you start being clear on what you want, those 2 things, I think, are what make people in multifamily fail. Because ultimately, everyone comes out and says, I don't have enough money. I don't have enough time. What you don't have is you don't have a clear plan. You don't have a role model or a mentor or a strategy or a technique to follow. And you do have a lot of limiting beliefs, energy blocks. You need to start with yourself. And then once you're really committed to multifamily or to Bitcoin or to whatever it is, you have to sit there and learn. We go to college for 4 years to get a useless degree, to do another 2 years, another 3 years. So if you can't take 18 months of your life to really learn a craft, then you're never going to succeed.
18 months. I love that. It kind of parallels your story about, getting first in the multifamily. But there are, I love that. I love that kind of taking your own personal responsibility, and that kind of goes within your own circle of competence and being a professional coach. But along the same lines, what are kind of the biggest myths that you see in multifamily investing that maybe I view as you as a really authentic guy and very transparent and not to blow the smoke up anyone's behind because it took you 18 months to get in.
There's a lot of myths. I mean, let's start with the biggest one. I don't know if it's the biggest one, but when you're surrounded by people who are regular 9-to-5ers and they're just used to going to work, and you come up with the idea of, hey, I want to do something different. I want to get into multifamily. Everyone's going to tell you you're crazy, and everyone's going to tell you it's really risky. And what's really risky is to listen to somebody tell you about something that they've never done before, and they're telling you it's risky. Now, if you have a veteran who's been doing it for 10 years and say, you know what, Clayton, it's a little risky, I would take his advice. But you're not going to hear very many people who've been doing it for years who become very successful. They're going to say it's very risky. What's really risky is not to get educated and to do it. There's the risk involved. The risk is not taking education times action equals results. That's the risky part about multifamily, not knowing what you know, right? The second one is really, where do you find the money? Everyone's always clamoring about, how do I get money? How do I find money? Well, when you first start out with, if you don't have your own capital, what you need to do is really become valuable to somebody else. How do you do that? There's so many ways to do that in multifamily, because multifamily is a team sport. The 4 ways to do that. If you don't have the net worth or the balance sheet, that's number 1. Number 2, you do boots on the ground. You property manage these deals for somebody. There's a lot of value in that. Number 3, you can raise capital for somebody's deal. How do you do that? Well, you've got to learn how to raise capital. You've got to learn how to underwrite deals. You've got to learn multifamily itself. And I think number 4, go out and find the deals. Go out and underwrite the deals. Go out and bird dog for somebody. There's so many different ways of getting into the space. And I think everyone uses that lame excuse of not having money to stop them. We've been able to refinance over $9 million from our portfolio to buy our first 1,000 units by ourselves, me, Jake, and my partner, Mike. Didn't happen overnight. It was a little baby step. It's that snowball. It took 18 months to find the first deal. After we found the first deal after 18 months, 3 months later, we got the second deal because we partnered. 6 months after that, we bought our third deal. We're at 200 units by our third deal. 18 months after buying our first deal, we refied that third deal. So we had money for our next deal. It doesn't happen overnight. It's a long game. And that's the other thing with multifamily. The next thing with multifamily, why people fail, or it's not a quick and easy thing. I was reading something about being transcendental versus transactional. Transcendental is something that really changes your life. Transactional is something that, hey, transaction's done, it's over. The fix and flip is sexy. It's wonderful. People can grasp it. They can walk into a crappy house and 90 days later, it's all done. It's beautiful. But guess what? Not the right tax bracket, and it's just a job. Unless you can monetize it, unless you can multifaceted it, where the vast majority of people don't, you're not in the right tax bracket, because it's more of a job. If you can do 10, 15, 20 houses a month and have that on autopilot, it's a different story. But that's a constant rinse and repeat. It's more transactional. Whereas multifamily, you plant the seed, you buy the asset, you got to milk that asset. Maybe you refi it, maybe you sell it, but you can hold it for cash flow, and the tax benefits and the principal pay down and the appreciation and all that goes with multifamily. It's a long game. It's a lot of work. And our society, unfortunately, is turning more and more to the dopamine effect, where it's instant gratification. Yep. And I think if anybody can teach their children something, is to try to delay that gratification. It's hard when you're younger, but as kids get older, if they can delay it and put it off, they'll be much happier in the long run if they can do that.
Wow. I love, I've seen Jake say this so many times: if it doesn't cash flow, let the grass grow. I love that. So what, Gino, I want to stay on this topic because you're one of the best in the industry, and being straightforward and being organic about it. What are the biggest wastes of time off the bat? We'll jump off this topic. I know that this is kind of a common topic, but I think that a lot of my listeners would appreciate hearing it from you.
So the biggest waste of time for any entrepreneur, any business person out there, is to do work. And this is really hard because I did this for the vast majority of my life, is to do work that doesn't generate revenue. I know it's hard to say out there, hey, listen, I can't find an employee to wash dishes at my restaurant. And I was stuck in the kitchen doing $15 an hour work when I should have really been doing higher level work at the restaurant, like maybe writing a second cookbook, doing some more YouTube videos, creating a better menu, going out and trying to hire more events, maybe some more cooking classes. Every entrepreneur has that problem, the I'm a mentality. I'm going to do this. I'm going to do that. I'm going to do everything. And you need to do that in the very beginning because you need to learn everything. But as you get bigger and as you get better, the 3 things that are going to propel any business, they're people, systems, and culture. Let me write that down for everybody. Everyone, I want you to really think about that. It's the people, it's the systems you implement, and it's the culture. And you can create your own culture in any organization. And that's what we've been doing for the last 18 months with Jake and Gino. I mean, we create communities that allow people to become the best version of themselves. That's our mission statement. And what kind of communities you create? One's for residents, one's for investors, one's for education students, and one's who are looking to service debt. So from there, our core values are make it happen, growth mindset, people first is the biggest one for us, unwavering ethics, And those are our core values that we have right there. So once you go from there, you hire from there, you fire from there, you grow from there, but you have to emulate those. I'm still packing books. I mean, people order the Honeybee and they want to sign copy. I'm packing those books and I'm shipping them because we have to make it happen. So I want to embody that culture. And it's not just a brand thing. You have to live by whatever your core values are, and you hire from them and you fire from them. I didn't do that the first 40 something years of my life in business. I always blamed the employees that I was hiring. I wasn't looking at myself and saying they're not a culture fit, or they're just not the right employee in the right seat. So it's important that you always evaluate your company and hire slow, take time to hire slow, and then just end up firing fast. When it doesn't work, you need to fire fast. And Jake does a great job of that. Once there's not a culture fit or there's something going on, you have to cut it out like cancer, because it will spread in the organization and it will take your organization down if you don't handle it right away.
I find you particularly adept at kind of seeing, because of your experience in being a professional coach, is kind of seeing the principles and in the values of an organization. Now, I'm not very sure about how your relationship works with Jake, but I kind of view you as from an outside perspective, is that you touched on briefly about your core principles, your core values. Can we jump back into that, because I think that this is important. For example, I'm in a family business, and there's kind of this code of ethics that is, you're in the family and you're gonna put a lot of effort, a lot of energy into it, but you can't expect that to be a part of your organization. Number one, if we're starting out as an investor, if you're starting out as an aspiring multifamily investor and you want to get into the game, should we be thinking about principles? Obviously, we're thinking about revenue generating activities. And how do we effectively create principles? Because your brand, the Rand brand, is incredible, and it's perennial, and it's extremely successful. So we'd love to learn.
So the first thing, as when you're starting out as a multifamily investor, let's start with things that you need to be successful to get your first deal. I think the first thing is, obviously, after you've done the education and after you've joined the community of like-minded people, really need to select the market. That's the first thing. Let's not worry about, you always want to think with the end in mind, right? But you want to think about getting into a deal. You want deal flow. So let's select that market. Where are you going? Are you going to be in your backyard? Are you going to invest outside your backyard? How much capital do you have? When I started, I tried to do it in my backyard. I couldn't do it. I ended up going to Rochester, New York, which is around an hour flight from where I lived. I invested outside of my backyard. You have to focus on that. I think the next step, what you need to do is really build rapport with brokers. Go out there and network with brokers and learn the market. This is going to take a couple months. You're going to need to do property tours. You're going to have to go out there and visit these properties. Mm-hmm. The next thing you're going to do, if you don't have the capital, start raising money, start meeting people, start creating substantive relationships, start sourcing a partner, get out there and meet people to actually go out and help you take these properties down. That's a little bit more difficult, but that comes down to, we train on that, is, selecting a partnership and working with the spouse or working with someone else who's going to become a partner. It's basically going to be a marriage, but you need to work on that, because multifamily it's almost like a team sport, we say, because there's so many different facets, so many different levers to getting into the business. So doing it by yourself in the beginning, Jake and I did it by ourselves the first 6 months, and then we got a partner on, then we started hiring property managers, then we started hiring maintenance staff. I think with the end in mind, always think of multifamily as a business. I think most people, when they get into it, they think of it as tenants, toilets, and they think of it as landlording. And that's a really key component. The 3-step framework is buy right, manage right, and finance right. So you need the manage right component. But in the book, The Honeybee, we talk about, don't ask how to do it, ask who to do it, which is really important, because there's people out there that can help you. And it goes back to the people part. When you're saying to yourself, well, I expect this of myself, I don't expect this of my employees. What you need to do is you need to create a story for your company. And why should anyone want to follow you? Leadership is really about coaching individuals, and it's about creating a vision for them to follow. How does someone like Starbucks, how does he get all those thousands of people to work for him and to actually create that business? Because he's created an amazing story. Howard Schultz's father didn't have health insurance. Howard Schultz wanted to create a company with health insurance so he could give benefits to his employees. And on top of that, he wanted a place for people to hang out after working and get a cup of coffee. So when you start an organization, when you start your multifamily, maybe you focus on helping disabled vets. Maybe you focus on helping, blue collar workers. Create a story and let that permeate throughout your organization. And with the RAM property management, the RAM partners, I really embody people first, because I'm really trying to help students. And people think I'm crazy. I'm like, you're helping people in your competition. And I don't see the pie as, as linear. I think the pie can be exponential, because one day a student will bring a deal over to us like they did like a month ago, and we'll partner up with a student in a deal. There's so many different ways to create it, but I think you need clarity on why you're creating this business, because it is a business. And what the great thing about it is, you can actually start levering up. You're leveraging people's time and you're leveraging money also, but leveraging time of people is really key. So become clear on what your mission statement is. That's why when you write a book, everyone is writing books. What is the story of that book? So the story for us is really always helping students out. It's really trying to help residents out, give that customer service, give them that ability, because they're often neglected. People in C apartments are often neglected. There's no customer service.
Right.
He wants to be the Chick-fil-A of apartments. He wants to get that customer service, and that's what we're trying to strive for. Whether it's investors in the Rand property and the Rand partners, we're syndicating deals. Whether it's the students, whether it's the residents, we're always trying to focus on people first. That's our mission. That's our core value.
That's incredible, and when you have a mission, you can clearly kind of delineate yourself from the competition, in that you're providing a value, and it's a specific value. It's very core. You're the workforce housing. You're providing the value for the workforce housing. If we are, so I'm very subscribed to the ideas of Cal Newport, and saying, just find work that you can get into and you can work hard at. Passion is kind of overrated. And I want to take that concept and I want to bring that into this context that we're in right now. And that's, what if we don't know where to start in that respect? Do we just go out and start trying to assemble a team, talk to brokers, and do all that? Those are the first steps, or is there another thing? Help some of our listeners that might be more in their fundamentals.
Sure. When you first start out, I think you have to focus, like you said, on the market. The second thing is be clear on what kind of assets you want to buy. Do you want to buy mobile home parks? There's nothing wrong with that. Do you want to buy C-class properties and multifamily? There's nothing wrong with that. Do you want to buy D-class in a war zone? There's nothing wrong with that. Although I would stay away from it, but some people, they thrive in it because they love that area. You can buy them really cheap. If you're looking for cash flow, great strategy. If you have the right property management company and the right temperament. I used to know a lot of immigrants back in the 70s and 80s that went into the Bronx 20, 30 years ago. Were in those D-class war zone neighborhoods. Now you can't touch those properties with a 10-foot pole, because they've just emerged and they've just become amazing. Do you want to buy B properties, A properties? I think the first thing is just become clear on what you're trying to focus on. The second thing, you really need to learn the market. You need to learn exactly what properties are trading for in the market. You need to know exactly what cap rates are. You need to know what expenses they are to run in the market. Learning that is really important. And this is all stuff where you need to get educated. You can go in bigger pockets and piece a clip out here and a clip out there and try to piecemeal everything. But as you know, Clayton, there's a lot to learn, and what you don't know. And syndication was one of those topics for me. I didn't know syndication until about a couple of years ago, until I started podcasters out there who were just really syndicating. We didn't do it. The way we learned, we educated ourselves tremendously. We got on calls with other syndicators, we got on calls with attorneys, and then we ended up ripping the Band-Aid off. We bought a smaller deal for us, something that was a little more comfortable for us, but committing and then figuring it out. That's what we did. I think, to go back to what else people can do, it's really, honestly, it's really going out there and trying to go to as many events as possible, seeing who's in the market, seeing who's in the space, trying to, I don't want to use the word pick everybody's brain, but trying to get information from them. And ultimately, you need to find a mentor or somebody who's doing it. And then once you feel comfortable with that person, sign up with them, because you're going to be part of their community. You're going to be going to their events. You're going to have access to their students, their coaching. That's really important, because when you're going through a deal and you have a question, you just pick up the phone or you watch a video, and you can learn so much from somebody who's doing it.
I agree with that completely. And I want to stay on this kind of same vein. What have you found, Gino, to be surprisingly effective at kicking you quickly to the next level in multifamily investing, and just growing your business in general?
For me, there was nothing really quick, because I wasn't that smart, to be completely honest with you. I was just really being persistent. And I think the hard thing is, especially in this type of market, in this type of cycle, you need to know what type of market you're in. Being really diligent with your numbers and being patient, being persistent, but being willing to walk away. That's really hard to do, because when you have a ton of capital sitting there, you always have to think you're putting it to work for investors. That's why for me, it was easier to make a deal for myself, because if I lost money, it was my own money. But now you're a steward of other people's money. And that's a wrong way to think of it, because I'm still a steward of my money. So if I'm losing my money, it's just as bad as losing an investor's money. But you really need to be diligent on, where that next deal is. You be diligent on placing the money. So just think about that when you're going out and looking at a deal.
Yeah, so tell us a little bit about kind of how you are approaching your deals now. And, obviously we're in the market cycle that we are, but you referenced a little bit earlier about you moving into syndication. Would love to learn about that part of your business, as well as kind of what markets you're in and yeah.
Sure. So everyone needs to understand that the three pillars of real estate that our coach Bill Ham talks about is, the market cycle, the debt that you're using, and the exit strategy. You need to be clear on all three of those, because everyone comes to me and says, is this a good deal? I'm always going to say it depends, right? It depends on what market you're in. Pittsburgh is in a different market cycle than Knoxville or than, Arkansas, Little Rock, Arkansas. You need to know what part of the market cycle you're in. Unfortunately, right now we're in the seller's market phase 2, where I'm thinking that things are going to slow down a little bit. If the economy slows down and jobs slow down, rent growth slows down, interest rates go up a little bit, we're going to see a hit in cap rates. I've been waiting for this for the last couple of years. It hasn't happened yet. The Fed keeps pumping money into the economy, and that's why it keeps these stock prices and keeps everything artificially raised. So when is that going to happen? I don't know if it's going to happen, but you need to know what part of the market cycle you're in. And I'm seeing people pay 4.5 caps for 1970 C-Cam properties, and to me, that's a little risky right now. I mean, Atlanta has it right now. Florida has it right now. There's a ton of competition. And in this type of the cycle, what you're seeing is there's a lot of demand for these assets, because when you're coming for money from overseas that has 2 cap in Singapore or in Asia or in Australia or in Europe, they're looking for rates of return here. If they're getting a 4 cap here, they're doubling their money. The other thing is there's a lot of 1031 money out there right now that's coming out that's stupid, that people are trying to save on taxes, so they're bidding up assets. The other part of the problem is that there's just such a demand for it right now because people are renting. That's the bottom line. Home ownership is at a 50-year low, so there's a demand for that asset. And the other thing is you have those tax benefits with cost segregation. So you have a perfect storm brewing for multifamily. I just hope the economy does not take a big hit, because a lot of these people are going to be they're not going to be doing the buy right, which is the first part. And I think the last component to that is the financing ability. I mean, if you have certain players in the game that are getting 7-year IO, 7-year full-term IO at a 3.4% interest rate, you're going to be able to overpay in these assets because you're really financing them really, really well. If they know their exit strategy is to exit in 3 years, they can do that kind of a deal. For us, we tend to be a little bit more long-term. So figure out what the market cycle is, figure out what your debt is. Are you going to pay prepayment? Are you going to have yield maintenance on the debt? And what your exit strategy is. Are you going to hold it for the long term, or are you going to get out of it in 36 months? You really need to look at those 3 components to assess a deal today.
Perfect. So I want to go actually into that exit strategy. So I had a meetup about a week ago, Gino, and a question came up, and I was ill prepared to answer it. We were talking about kind of the debt, where we are in the market cycle, and then securing the debt. Even though they're really, really appealing interest rates. One of the attendees asked me about, what if I just am buying and holding? I don't really care that much. I'm going to get great interest rates, but I don't really need an exit strategy if I'm buying and holding. What would you say? Maybe Bill Ham would be the better person to ask about this, but what would you say about, I just want to buy this asset and hold it for the next 40 years or 50 years?
Well, that's something a novice would say. I probably would have said that 4 or 5 years ago. You want to limit your downside risk. You want to limit your risk on anything. So you need to have a clear strategy on what your exit is in anything in life. That's why I love whole-term life insurance. Whole life insurance. You put that money in. The exit strategy is you have death benefits. You have an estate tax. So it's all about planning. Now, if you're going to buy an asset, let's just say, for argument's sake, a $20,000 a unit, and then all of a sudden it's worth $50,000 a unit. Do you think the cash-on-cash return right now, or the return on your equity sucks? I would say it does. Do you think you could probably sell that, do a 1031, and buy up into something bigger? I would probably do that strategy. And that's what people are doing in the last 3 years. That's what's able to catapult this market. Now, I want to buy and hold for the long term also, but there comes a point where you're going to sell some of these assets when it makes sense. So give yourself the flexibility to do that. Go into it with the long term, because right now, long-term fixed rate financing is great because the rates are so low right now. If you can lock it in for 10 years, great. But I'd like to see a little step down just in case you're syndicating a deal, because syndicators tend to want to be able to flip out after 3, 4, 5, 6 years, because that's where they get their money on the back end of selling this deal and the front end of the acquisition fees. But if you're buying for yourself, it really depends what you're trying to do. Things change. In 3 years, markets change. You change as a person. Now, if I was going to tell you 3 years ago, I didn't want to buy assets that are less than 100 units, I'd say, Clayton, you're crazy. I'm going to buy anything. But to be honest with you, now that we're bigger, the economies of scale, we're going to a different market. It doesn't make sense for me to buy an asset that's 30 or 40 or 50 units. I'm looking to sell some of those assets right now because, like I said, we're scaling up. So what you don't know in the beginning, that's not the way to look at it. You want to actually have it open. So if you want to sell, you can sell. If you don't want to sell and you want to hold on, that's great. And what kind of debt are you getting? Are you getting community financing where it's only 5-year term and after 5 years it resets or it balloons? That's what you have to be worried about, because right now rates are low. Can they go any lower? I don't know. I didn't think they'd go any lower a year ago, but I just think in the long run, rates are going to go up. So if you can lock them in and give yourself the flexibility to want to sell, because let me tell you, that is a great thing about multifamily. You can buy it at a certain price, force that appreciation, maybe refi the property. Let's say you don't want to sell, but you want to refi the property. But if you have a really exorbitant prepayment penalty, then maybe you can't do that. You have equity trapped. And when you have equity in a property, equity has zero return on the property. You can be allocating that equity into another deal. That's what makes people rich, by using that equity in their deal to buy another deal. Make that equity work for you.
Wow.
Hope
No,
that
that was a really good answer, because there is no answer.
That's right.
It's situational. It's circumstance by circumstance, and I think that's important to note. When you're investing in these assets, you're not investing in a single family home.
Mm-hmm.
You're really not. Now, if you're investing in a 10 unit, well, you have to still consider the exit strategy, because like you just said, well, maybe you want to, you get that 20 a unit to the 50 a unit. You want to sell it. You want to roll it into 1031. You still want to think that, because if you start buying more and more assets, like you were saying, I mean, 3, 4, 5 years ago, you would have been like, I want to keep all my little 30 units.
Mm-hmm.
But now you don't, because you're moving it. So that's really important. That's really important to keep in mind. So what is the business plan for Rand right now? I know that you guys this year have had a couple of acquisitions, but where are you looking? What markets and why? Maybe walk us through a little bit about why you like some of these markets.
Well, everyone out there should look at the book, read the book. I forgot I think his name was Porter. Chris Porter, don't quote me on the name. His book was called Big Shifts Ahead. It's really a demographic book, and it might be boring to some people, but knowing where the demographics are will tell you where you should invest in multifamily. Seems like Phoenix and Arizona is a really hot place, and it seems like Texas is another hot place, and it seems like the Southeast is another hot place. I would look all in the Southeast because of the demographics, because of the tax laws that Trump enacted on the blue states for property taxes, and also just where jobs are going. The weather's better. The quality and the cost of living is cheaper. So you have tons of people moving down to the Southeast, whether it's Nashville, whether it's Knoxville, whether it's Jacksonville, Florida. We're investing in those markets. We're vertically integrated, so we control all aspects of our business. So we want to stay within a 3 to 4 hour radius of Knoxville, because we want to manage our own assets. So we're able to touch Lexington, Kentucky, Louisville, Kentucky, parts of North Carolina, parts of South Carolina. We went to Huntsville last week, underwrote a deal. Parts of Tennessee, even parts of Florida, since my brother's moving to Florida. So we'll start looking in Jacksonville. But I think the important thing for all the listeners out there is pick an economy that's emerging, pick something that that jobs are going to continue to flow to. So when we do go into a recessionary, you're going to at least have those employers set up where they're not going to flee. You want a diverse jobs. You in Jacksonville, you have the ports here, you have healthcare, you have banking, you have an Amazon super center here. You have so many different types of jobs here that if you do go into recession, you're still going to have those jobs. And I don't think those employers are all going to pick up and leave. So we're out here in the Southeast, and we're trying to underwrite deals. I mean, listen, we've underwritten 45 deals in the last 4 months. We haven't closed on a deal. We've closed on only 3 deals this year. Usually we try to between 4 and 5 deals. It's only been a three closed deal this year. So being diligent, underwriting deals, not getting desperate. That's why you want that deal flow. That's why I want to continue to network with brokers. It's always the next one. It's always the next one. And
Right.
just focusing on that market. Like I said, we're within 3 hours of Knoxville, so that gives us leeway to go into a lot of really good markets.
That's incredible. So I want to just jump into one thing you briefly said, and then we can move on to kind of our fire round at the end here. We're running out of time, but so you have said many times to network with brokers, and I actually was speaking with Brian Burke a couple of weeks ago, and he's
Smart dude.
smart dude. He gets it, and he talks about growing your business organically, which is actually very similar to your business model, and I really find that's one that will sustain through a recession, through a different market cycle. Have you found it to be effective to go to other owners through different ways of brokers, or should people forget about the get rich quick in the direct mail? Are there any other ways to get leads?
Well, there's a lot of ways. I mean, one way to get a lead is to go through your network. Our deal we got in December of last year, our community banker had a deal that one of his banking relationships was selling. The guy was selling, and it turns out that it was our title company that the owner was selling an asset. So we got this deal through our community banker. A lot of the relationships you have, they may have off-market deals. Just being out there, talking to a property management company in the market is great because they have assets that aren't running really well. They might know an owner who wants to sell. Real estate and multifamily specifically, when you get in the 100 units plus, mailers are a little bit harder to work, especially in this type of economy and market. People know what their assets are worth. The smaller mom and pops, you may be able to work with direct marketing. I would say 50 units and less. That's a much better strategy. But when you get into the bigger assets, it's really talking to the multifamily brokers who are the brokers in that market, because they have these big buyers lists. You want to get on the list that doesn't get an email, that gets a call. You can do that by actually, executing, by going to the market, doing the property tours, telling that you're serious about it, and learning about the deals. And like I said, Clayton, this is all cyclical. This in the next 18 months, brokers aren't going to have the upper hand anymore. There's going to be more sellers and less buyers. Right now, there's a lot of buyers out there. There's a lot of competition, so they don't need us brokers. But playing the long game and being in front of them, and when things do change and these assets do get devalued, and you have more of a shot, you're going to be in there. So that's why everyone says, is it the right time to start multifamily? It's always the right time, because if there's deals or there's money, one or the other. So when there's money out there, network with the people, because then once the money runs out, you have that money, you have those networks, the deals are going to come back. They're going to come back to us. It's just not a matter of, not a matter of if, it's just a matter of when.
I love that. That's a really simplistic but really concise way to look at market cycles. It's either you're in a deal market or you're in a money market, and because equity is plentiful now. I mean, you can find equity on the street corner, but deals aren't there, and then it's vice versa. That's a really helpful tip. So let's jump into our fire round here at the end. And the first question is actually going to be a softball to you, my friend. What is your number one real estate book?
I'm going to give you someone else other than me. I'm going to give you two. I love Ken McElroy's The ABC of Real Estate Investing. I think that's what it's called. He's written a couple of books, Ken McElroy. They're so simple to read. If you've never picked up a book, they're amazing. It's such a great book to read. I love that book. The other one is, another competitor of ours, an educator, Dave Lindahl. He's put out a couple really excellent real estate books. Emerging Markets is one of them, and I think Multifamily Millions is the other one. They're excellent books. I mean, you have to give kudos. I love them. They gave me a lot of advice, a lot of education. I love those books. Then obviously, of course, our book. I love Wheelbarrow Profits. It talks about the 3-step framework, and then the Honeybee, which talks about multifaceted, multifamily, and how you can add complementary streams. But I think those two authors in the beginning are excellent. I think you should check those books out.
Yeah, I think that it's very helpful especially when you're beginning the process. And my listeners know that this is, I'm kind of documenting my journey and beginning my process. That books that focus on fundamentals are really important. I found Lindahl extremely good at that. Mm-hmm. I've read some of the Rich Dad, Tom Wheelwright with taxes and the ABCs of real estate investing. But I would also say that, the Wheelbarrow Profits book, It's a really good way in thinking about buying your assets right. And then you have to, guess what? You got to manage them right. Because if you don't manage them, it doesn't matter how well you buy them. And then most importantly is you got to make sure that the finance is there. You have your equity, you're working with a community banker, you're working with whomever. That's super important. And I think that the Wheelbarrow, you and Jake really set that up pretty well. So what, again, this is kind of a tough question, but what are some of your were some of your limiting beliefs in getting into multifamily?
Well, for me, in the very beginning, I couldn't invest out of my backyard. That was a limiting belief of mine. I have to touch it. I have to drive by it. The other one was, how am I going to scale up? Where am I going to find the money for my first deal or second deal or third deal? Third thing is, how am I going to deal with tenants? That's going to be really hard. The fourth one is, how am I going to find people to work for me? All of those were limiting beliefs for me when I started, and they were just limited by my thoughts. Once you crush a limiting belief and you just crush it in your mind, you can overcome anything. Like I said, once I figured out, hey, we can refi and roll this, we can syndicate this deal, I can partner with other people, I can even sell it and consign it and wholesale it. So I can get into it so many different ways. And you become so creative, limiting beliefs are gone, they're shattered. So I give you 4 big ones there.
Those are good ones. Those are pretty basic in kind of how most people get in this business. So what drives you to keep investing in real estate?
For me, it's learning. For me, it's staying up to date on the market because I have students that I have to really serve. So how can I sell education, or how can I give people advice if we're not taking action every day? So that's why, the whole Rand family is doing different things, whether it's finding deals, whether it's underwriting the deals, whether it's raising the capital, whether it's getting mortgages for our students, whether it's property managing, all these things, they're fluid. I mean, basically, when you think about underwriting deals, not much of that changes, but market cycles are changing, strategies are changing, technologies are changing. So I like to learn. And Jim Rome actually said it again. He said the essence of life is growth. So I don't want to sit on the sidelines and stay home and sit on the beach. That's not for me. That might be for some of the listeners out there. I just wasn't wired that way, and I would be really bored. So I want to just continue to grow. That's why I got out of the restaurant, because I wasn't growing. So for me to continue to grow is to continue to buy these assets, never be an expert in what I do, and continue to learn.
That's awesome. That's more of a profound form of motivation, and it's a pull instead of a push. If you're going after just the wealth, I mean, you guys don't need any more. You don't really need any more after a certain point. You got thousands of units. So what was your biggest challenge in real estate, and how have you learned from it?
So the biggest challenge for me was my first deal. Was a mobile home park back in 04, 05. I partnered with somebody, and the deal was, I didn't know mobile home parks. I didn't know due diligence, and I made a big mistake. And that did not hold me back. Most people would have the energy block of an assumption. I'm going to assume real estate's risky because I crapped out on my first deal. I looked at it differently. I had enough motivation that I wanted to get out of the restaurant and learn from this and say, well, how you look at a problem as an opportunity. How did this problem start? It was all about me. I mean, I know the guy was a crook. I know I can blame him till I want, but until I took responsibility, and I was the one who signed on the dotted line, and I was the one who didn't fly down there, and I was the one who didn't check his business plan. I didn't know about syndication. I didn't know about a lot of these things. Once I learned from those mistakes, I said, okay, now I want to choose multifamily, and multifamily's for me. It's really, honestly, taking back that responsibility and learning the craft and really surrounding yourself with great people.
That's awesome. That's a great. So, Gino, wow, thank you so much for spending time with us today and really imparting some fundamentals, some blocking and tackling that's so needed today. That's kind of organic and it's kind of refreshing. How can our listeners get in touch with you? Maybe they want to invest with you, or maybe they want to learn a little bit more about what you're offering in your training programs.
I would just tell everyone to go out to jakeandgino.com. That's our website. We have 4 weekly shows. We have the Multifamily Zone show. You can see the picture behind me with my wife. We do a spousal. It's more communication. It's more working with your spouse and dealing with business problems. The Movers and Shakers podcast, which is on my other side of my shoulder, is a podcast with students who are closing deals. It's a great podcast to hear how students are doing it. We have the Wheelbarrow Profits show, which is a weekly show on Thursdays that, we highlight high-level multifamily investors and, general business. And then we have the Rand Partners podcast, which is a syndication podcast. So just go on there. You'll take a look at it. We have tons of blogs, tons of articles. We have our books on our website. So just go to jakeandgino.com and just start searching that site.
Boom. Guys, check this website out. I mean, if not, just to listen to his podcast. Really, really great stuff. And also I find that one of the best resources I've ever found about talking with brokers. There's a series of questions that you did a couple of years ago about how to start a conversation with brokers. Invaluable. I mean, I literally am like, I got my phone here. I'm like, calling another broker, and I'm like, oh wait, what did he say again?
That's awesome, dude.
Cool. Thank you so much again, Gino, for spending your evening with us. And I'm really excited to hear the feedback.
Clayton, thanks. And everyone, have a good evening.